Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights and inspiring stories. Today, we're going to explore one of the most critical components of the global economy: central banks and interest rates. Imagine you're an entrepreneur looking to start a new venture, or an investor seeking to grow your wealth. Understanding how central banks and interest rates work is essential to making informed decisions about your business and finances. So, let's dive in and explore what central banks and interest rates are all about. Central banks are the institutions responsible for managing a country's monetary policy. They set interest rates, which determine how much it costs to borrow money. Think of interest rates like the price of borrowing. When interest rates are low, it's cheaper to borrow, and when they're high, it's more expensive. This has a ripple effect on the entire economy, influencing everything from consumer spending to business investment. The first central bank was established in Sweden in 1668, and since then, every major country has followed suit. In the United States, the Federal Reserve, also known as the Fed, is the central bank responsible for setting monetary policy. One of the key principles underlying central banks and interest rates is the concept of supply and demand. When an economy is growing and there's a high demand for loans, interest rates tend to rise. This is because lenders can charge more for their money when there are many borrowers competing for funds. On the other hand, when an economy is slowing down and there's less demand for loans, interest rates tend to fall. Influential thinkers like Milton Friedman and John Maynard Keynes have shaped our understanding of central banks and interest rates. Friedman argued that monetary policy should focus on controlling inflation, while Keynes believed that fiscal policy, or government spending, was more effective in stabilizing the economy. During the 2008 financial crisis, the Fed lowered interest rates to near zero to stimulate economic growth. This move helped to stabilize the housing market and encouraged businesses to invest in new projects. On the other hand, when interest rates are too low for too long, it can create asset bubbles, like the dot-com bubble of the late 1990s. Another example is the European Central Bank's quantitative easing program, which was launched in 2015 to boost economic growth in the Eurozone. The ECB created new money to buy government bonds, which helped to lower interest rates and increase lending to businesses. So, how can you apply the concept of central banks and interest rates to your own business or career? For entrepreneurs, understanding how changes in interest rates might affect borrowing costs is crucial. If interest rates are low, it might be an excellent time to secure funding for your startup. Conversely, if rates are high, you might need to reconsider your financing options or postpone expansion plans. For investors, knowing how changes in interest rates can impact the stock market or bond prices is vital. Generally, when interest rates rise, bonds with lower yields become less attractive, which can lead to a decrease in their price. Similarly, higher interest rates can make borrowing more expensive for companies, potentially affecting their profitability and stock price. One practical tip is to keep an eye on economic indicators like GDP growth, inflation rates, and unemployment numbers. These can give you clues about where the economy is headed and how central banks might respond with their monetary policies. Diversifying your investments across different asset classes is also a good strategy to reduce your exposure to interest rate risk. In addition, it's essential to understand the concept of forward guidance, which is when central banks communicate their future policy intentions to shape market expectations. This can help influence economic decisions even before actual policy changes are implemented. To take it a step further, let's explore some specific business concepts related to central banks and interest rates. For instance, the yield curve, which plots interest rates against different bond maturities, can provide valuable insights into the economy's future prospects. A steepening yield curve might indicate expectations of higher growth, while a flattening yield curve could signal slower growth ahead. Moreover, research has shown that small businesses are more sensitive to changes in interest rates than larger corporations. This is because smaller businesses often rely on loans with variable interest rates, which can increase their borrowing costs when rates rise. As an entrepreneur, it's crucial to consider this when making financing decisions for your business. In conclusion, understanding central banks and interest rates is not just for economists or financial experts. It's essential knowledge for anyone navigating the world of business and finance. By grasping these concepts, you'll be better equipped to make informed decisions about your finances, career, and investments. Remember, every great business starts with a deep understanding of the economic environment it operates in. That's it for today's Business with Louis. Be sure to like, share, and subscribe, and join us next time as we explore more exciting topics in the world of business.